Yeah, I think the data I'm looking at daily is obviously different to say weekly and monthly because some economic data just isn't coming out, right? So
Yeah.
as I said in the earlier question, I'm trying to take data from rates to FX to equities. So, I'm looking at nominals, curve regimes. So broadly speaking, basic is the twos, tens, all steepening, they're flattening, doing this on a daily basis with different lookbacks. I'm looking at rate expectations, sector performances, but I'd say most importantly, kind of day to day, I'm looking at the cross asset returns and correlations and then how they're progressing across the week. So, cross asset correlations and returns is, creating your larger bucket of assets. How are they all correlating? Are they being driven by a macro move or are returns dispersing? Or is there dispersion in returns? And then I'm kind of asking myself, why is that?
Exactly. When the cross-asset correlations, they are, I think, a very important input to everything. And I think that's also where I'm still struggling to wrap my head around that a lot of people are struggling. And let me maybe boil it down or dumb it down to I think why people are struggling. I mean, when you look at cross-asset correlations, what I at least think like people think is, okay, you have the market, the S&P, you have it sell off because it reacted to some type of news that just broke. Maybe it's to an interest rate announcement or like you have a labor market announcement, and then people are like, well, I mean, now everything is already priced in that sense because the market already reacted. How is this predictive? But I think this can really tell you about what is sort of currently driving the market, what are people spooked by, and what is the marginal driver, so to say. I guess getting the information from something that already happened and then hooking it up to your broader picture, this can kind of inform you where we are sort of in the time horizon of also your view that you informed and that you built, as we just explained beforehand. Is that a fair assessment of also why you look at cross-asset allocations?
Yeah. So you made a good point, which is like, at all times, we're trying to find what is the marginal driver of the asset and what that's going to do. I'll just use, a recent example is that when the war first broke out, we clearly see that the correlation between oil and equity markets were so strong, right? So, you can begin to attribute returns to say oil is the marginal driver of asset prices right now. Whereas as time goes along, once those correlations and returns, disperse, you begin to say, well, the marginal driver is elsewhere. And then you may run a correlation to say that, rates are driving equities more than the dollar, for example, or than oil.
But exactly to this point, because I think people were kind of just looking at markets and there even like some experts were sort of amazed, because they were like, okay, usually like, if oil, kind of breaks out, this shouldn't be very positive equities. That's at least what I heard, and that's why they were kind of amazed, and wouldn't that be kind of, to your point, an argument for, okay, maybe it's something else that's currently driving asset prices in the first place, which was maybe, because we have the oil shock, inflation could kind of spike, at least explain inflation expectation, and that's why real rates could be dragged down, and that's again nominally positive for equities, or what I mean. I mean that's sort of where people were
I would say
confused.
That if we know that at all times growth or inflation is driving a given market, then practically what you can do is, when I reference those baskets that I'm talking about, the growth in labor particularly, and then inflation basket, what you can actually do is start to say, okay, what is the standard deviation of returns after those particular news releases? And then how do we trade 1 day, 1 week, 2 weeks after? So for example, if NFP comes out and the standard deviation of a move is higher, then let's say when CPI gets released and we're still trading above that level in a week, you can begin to say, okay, I think the market here is more so focused on growth over inflation. And this is very broad to begin with. You can start narrowing it down from there. But what you want to do is kind of say, okay, how is the market moving in terms of standard deviations? How aggressively are we moving at each data point? And where is the market a week later? We're still trading above or below that level. And then you can kind of say, okay, now how is the market correlating and where are returns and why is that? I'm just always trying to attribute why things are happening, because then I can build a view.
Yeah, exactly. That's to my question, how to know as an investor what exactly is the marginal driver of asset prices right now, because you can have a view, and that's maybe a follow-up question that I would have, where it could be impacted by something which looks very likely to be happening. I mean, the best example is really, we had this oil shock. A lot of people were expecting higher oil prices, and then from there, they're expecting them to feed over into inflation. Thus, there might be an interest rate hike further down the road. And as you established yourself, markets are forward looking. So at some point, they will be pricing this in, but maybe from the get-go, they haven't in that sense, because it wasn't the marginal driver as of yet. It was not thing driving asset prices just yet, because it would have to percolate through markets as well. And so that's kind of like for me, the $1 trillion question, like how to know what exactly is the marginal driver of assets right now. And the question is how to figure this out.
I'll just refer back to what I was saying. My personal opinion, people have different views, but I think you're always going to know what's driving returns based upon correlations, because, the stock bond currency correlation is so important, right? Because if equities are just a function of what rates and FX are doing, then at any given time, it's either rates or FX, broadly speaking, that are driving returns in equities. So, like, to answer your question, at any given time, when running correlations, you're going to see what's driving markets. Like I used as the example just a minute ago, which is we knew oil was driving returns. Correlations were spiking towards 1. So we knew oil was driving returns in equity markets. But then as that kind of declined and headed back below, say, 0.5 correlation, we started seeing rates have more of an impact on equities. So now you say rates is the marginal driver. But then the chain continues, because then you say, okay, why are rates trading this way? And it's always going to be your growth or inflation bucket.
Mm-hmm. And how do you then play this as an investor? Because obviously people might then be asking, okay, correlations is only something you see after the fact, because you've seen it correlate, and so it's like past data. And then obviously you can assess, okay, this is the correlation which is happening right now. It might be very strong, but obviously what will it be in 2 weeks, 3 weeks, 3 months, and how do you then kind of go from there to probably have an edge, and to say, okay, at some point I expect these correlations to weaken and I want to be before the herd, potentially positioned for this, once something else starts driving the market or asset prices. You know what I mean? How do you kind of go from here to there then, without just always running behind and like, okay, now the entire market has already priced it in again, and now I get it, but it's already too late for me to play this,
Yeah, so I'll say that, from my own point of view, I think edge comes in particularly easier. Doesn't mean it's easy, just easier when correlations are kind of spiking towards 1. So I'll just use, last April 2025 as an example, right? Is when the markets were all trading directly correlated and everything was selling off, right? All that the market was doing was pricing an extreme, because, for example, when the war broke out, everyone's pricing an extreme to say that oil stays above 100 XYZ. The extreme is always priced immediately. So that's where my edge comes in, because I say, okay, the extreme is priced in. We've got implied volatility trading at an extreme. We've got all assets correlating with each other because there's one macro driver. What then begins to say is, okay, how likely is it that this extreme really comes into play? Yeah. And then what you begin to do is build cases around that. So, for example, last April 2025, when everyone was pricing this extreme recession and tariffs on everyone, I kind of looked and said, okay, has the real macro backdrop changed from 2 weeks ago? No.
Yeah.
Okay. How do I view growth? Still strong. Okay. So unless this really comes into growth data, then we're trading at an extreme that I believe is mispricing the real growth and inflation backdrop.
Very, very astute and great point, because I feel like that's exactly what you want to be looking at as an investor as well, or want to be looking for. You have these extremes. And as you said, the market is very good at pricing them in real quickly, and because everybody is panicking. And I'm also trading digital assets, and there you have it to an extreme, which is maybe not even known in traditional markets. But then the question, as you said, is really, okay, is this extreme? Is it actually going to get reality in exactly this great of an extent, or to that great of an extent? And then maybe it might be happening further down the road, but like real world is always, except for maybe if there's like an asteroid hitting Earth, then I guess
Yeah.
we will have like extreme cases, which are really extreme in that sense, and they're right here right now. But usually then I think there's an overreaction. That's also how humans work, and from there, even if maybe further down the road we get everything that was kind of promised and it was bad, we might only get gradually we get there, and so at least in the short term, within that period, you have a chance of kind of having some mean reversion, which then maybe might go back to the old state that everybody was expecting. And usually also see that people were just wrong. It didn't pan out or the way they thought it would be. It's not the end of the world, so to say, I guess that's probably a point. And that's where you get your alpha from, right?
Exactly. I think it's funny because there's always this quote that comes to mind, and it says, "I'm an old man and I've known many troubles, many that have never happened." And it's like, when asset markets price an extreme, we're pricing something that we know that many times doesn't happen. When I say this, I'm speaking about like faster news events, tariffs, the war. We're pricing many extremes in that market that ultimately don't happen. And then that's why I said I feel like edge becomes easier in those times if you can find specific returns that aren't being priced.
Just quickly coming back before we bring this to a close, to like, okay, the marginal driver, maybe we have established it is really active, and maybe you can summarize again, how do we know that a marginal driver that we've been looking at is really active and sort of the one pricing or like driving the markets right now? Is it really the correlations that you're looking at, or is there something else that you can check? And then also maybe a follow-up question from there. How do you quantify, maybe by how much, this is a driver? Is there also a way? Because usually I guess it's not only one thing that is driving markets.
I'll say this. I'll say correlations is a massive, massive one. If you want to keep it broad, you want to know the correlations, and then you want to see what's leading and lagging markets. So if rates move up aggressively, does the dollar and equities track that? And if so, you can attribute to say that that was a rates-led move. So there are two things I would say is correlations and then the lead and lag. And then in terms of quantifying a view, I believe that was your second question, right? In terms of quantifying a view, I want to go back to what I was saying earlier, which is correlations and the whole lead and lag is going to help you attribute the move. But if you want to see the marginal driver in terms of broad market growth and inflation, you want to do what I said earlier, which is how is the market moving on an economic data print, the standard deviation today, and then the last 5 prints that come out. That's what you want to do. And then you want to say, okay, in a week's time, are we trading above or below that level, and why? So if CPI comes in, let's just keep it basic. If CPI comes in hotter and the market sells off and the move is a higher standard deviation than usual, and then in a week's time, we're still trading below that level, that's the market accepting that really is driving returns in equities.
Yeah.
But if in 2 days' time, we mean revert the move and trade above that level, then not necessarily it was that inflation is driving the move.
Yeah,
exactly.